Hi, my name's Gabby Parsington and you're watching Smart Money, the show that gives you the inside edge on where smart money resides. Today, we're looking at a big trade by the CEO of the franchise group, the indirect parent company of Liberty Tax Service and Buddy's Home Furnishings. The franchise group is focused on the evaluation and acquisition of franchise-oriented or complementary businesses. The Virginia Beach-based firm owns Buddy's Home Furnishings, a specialty retailer engaged in the business of leasing and selling consumer electronics, residential furniture and household accessories. It currently has a market cap of around $861 million, with annual sales of $132 million, net income of minus $2.1 million and EBITDA of $13.2 million. Randall Brian Kahn is the firm's CEO, who is also known for being the founder of Vintage Capital Management in 1998. He knows his way around a balance sheet and began his career in 1993 in equity research at Fidelity Investments, where he was primarily responsible for the analysis and selection of equity investments for various portfolios, with assets in excess of $400 billion. In 1997, he was selected as one of the most knowledgeable buy-side analysts in an annual Reuters survey of S&P 500 companies. No mean feat. Since then, the Harvard graduate and CFA holder has served in an array of executive roles. On the 30th of July, Kahn purchased 400,000 shares for an average price of $23.25 in a trade totalling $9.3 million. A tremendous apparent vote of confidence in a company as the economy creaks with uncertainty. The trade comes days after the company announced that it is providing Tuesday Morning Corporation, an off-price retailer specialising in name brand products for the home, with a $25 million debtor-in-possession loan as part of its bankruptcy proceedings. Let's take a look at the fundamentals. The franchise group's return on assets of minus 0.11% is worse than the rest of the industry, which averages 1.47%. Its profit margin of minus 1.63% also falls short of the industry average of 10.94%. The firm's price-to-earnings ratio is high, almost double the industry average, but its forward price-to-earnings ratio of 9.32 indicates a rather cheap valuation of the stock. The firm's low PEG ratio, which compensates the price earnings for growth, also indicates a low valuation of the company. When comparing the current price to the book value of the franchise group, we can conclude it is valued correctly and also trading at 2.62 times its book value. FRG is expected to show a strong growth in earnings per share, and in the coming 2 years, EPS should grow by 104.32% yearly. However, revenue has decreased by minus 24% in the past year, which is quite bad. Still, with a yearly dividend yield of 4.08%, the company is a good candidate for dividend investing. Looking at the technicals, we can see that the stock has fully recovered from its COVID-19 plunge and is now sniffing around its 2019 highs. Momentum is just about to move into overbought territory and is trending upwards, and the 50-day moving average previously crossed over the 200-day and is now offering near-term support to the uptrend. Well, that's all we have time for today, but as always, make sure you do your own comprehensive research before making any investment decisions. Thanks for watching and join us next time.